Wise then, a company that we both like very much, is a big part of the BritBox, is not in the FTSE 100 because it doesn't qualify. But they have come out with their Q4 results and a kind of gesture at the end of the year for 2025 as well. But the kind of full annual report is still to come, as it often is here. And no doubt when the annual report comes out, by the way, people will look at this and go, wow, this is incredible, and forget the fact that it was already reported in the thing earlier this week. Anyway, here's what they've done in Q4. They've increased their number of customers to start off with by 17%, taking them to 9.3 million customers. And those increased customers have been sending more money abroad using their platform. So cross-border volumes up 28%, taking them to 39.1 billion is the number I've got written here. Their take rate has come down, possibly for a couple of reasons, but the reason they gave was more people coming into their kind of higher value, higher volume category, and they kind of have a take rate that comes down the more you set, or when you start sending higher and more amounts. So take rates come down to 0.53%. That's down it's down 0.14%. Basically, it was 0.67, and that's their kind of cross-border volume business. They're transferring money around. On top of that, they have people with balances in accounts and on their platforms. They now have 17.1 billion in balances. That's 29% higher. They split out the interest they earn on that into what they call underlying, which is the first 1%, and kind of extra stuff, which is anything beyond that. The extra stuff was down 4% because interest rates are lower. The underlying, of course, was up 29% because the balances are up 29% and 1% is the fixed number that they have here. So these are exactly the same. So it was 41.1 million in the first 1%, and then 103 million in I guess non-underlying or extra interest income. And that got them to underlying income from a combination of cross-border stuff and interest on deposits, that first 1%, of 350.4 million, which was either 15% higher or 13% higher, depending on whether you care about constant currency. It's higher if you decide that constant currency is fine. So they got hit by a slight FX headwind. Aside from that, they're doing a lot of impressive things. Connections in Mexico, more instant stuff in Latin America. Bear in mind, this is basically a company that is driven by being faster, cheaper, and more reliable. So they're cheaper in that their take rate is coming down, tick. They are faster in that a partnership, I think, in Latin America is now allowing pretty much virtually everything within 24 hours and a lot of instant transfers. More reliable. I didn't pick that up from this particular update, but no doubt we'll hear at the end of the year the ways in which that's been coming through. So for the full year, customers are up 21%, cross-border volume up 23%, underlying income up either 16 or 18 again, depending on whether you care about constant currency here. Growth-wise, this is pretty strong, Steve. In terms of the stock, I was just having a look. It appears to be trading roughly where it IPO'd, having gone in a kind of bucket shape, more or less, like down quite a lot and then kind of across a bit and then up a bit, in a not in a smooth kind of curve, but in some fairly jagged ways. But by and large, if you bought this stock at the IPO, you're pretty much back where you started. But it IPO'd in 2021, and in 2021 earnings per share were 3p. In the most recent set of earnings per share for the full year were about 34p. So it's the same share price, as it were, but you are getting a lot more money on a per share basis, by the way. So that's factoring in any dilution or buyback or anything like that. You're getting a lot more for your money at this stage, Steve.
I think what it's getting, Steve, is disrespected. I think if it was, if this just traded on a European market, it would be probably twice the valuation, and if it traded on an American market, it'd probably be 3 times the valuation. Steve, we're sitting around messing around with this company around 10 billion, and my perpetual worry about it is that somebody takes it out before it gets a chance to, really realise what price it should be. So these results they're really good. I mean, you look down the list of it, and there's really not an awful lot to complain about. They're expanding in the right areas. They're in the places that you want them to be for cross-border business. I guess they have a small threat of how the tariffs would affect them, but largely you got on this report top to bottom, and it looks pretty good. Now, I noticed there was an amber flag because the FCA fined Christo Klarman um, last year, and that brings into context. It was a CGT issue, and it brings into discussion his fitness to run the business under the FCA's judgment, not my judgment, because obviously an owner of a publicly listed business like this shouldn't be getting fined for CGT issues, and he got fined about nearly £500,000, I think. Um, so that is a slight amber flag that I picked up in the news. But yeah, there's nothing in this report that I didn't think was going pretty well. I like all the ideas that they've got. I like the moves that they're making. I think the mix up with oh gosh, I think it's Itaú Unibanco, which is the one. I think it is the biggest bank in Latin America. Is a good tie up. You can see that instant transfers are picking up every year. 62% to 65% in this most recent quarter now. Wise promised that they would continue to work on instant transfers. They don't want people waiting for money. That's one of the things I think is bad about their rival services. And they continue to make those connections, bring partner banks online, and facilitate these instant transfers. So yeah, really, really impressive. I think the market maybe got a little bit excited about that take rate dropping down, but it's a little bit like looking at something like Adyen, which is, they probably should just stop reporting the take rate, to be honest with you. And it's probably one of those nonsense metrics that people get a little bit excited. Oh, they're dropping the prices because they've got loads of competition, and it's nothing to do with that. It's just that some guys moved £1 billion worth of volume on and expects to get that a little bit cheaper than Joe Bloggs who's sending £10 back to Kenya. So look, I think this is a really fine company. I think its biggest risk at the moment is that the UK doesn't seem to respect it as a business, and lets it trade for a lot cheaper than it should do, Steve.
Yeah, I was interested you mentioned the possibility of it being taken out. When it comes to things like take rate, so the way I look at Wise is as a kind of EDLP business, basically, and then it offers to do stuff cheaper than everybody else. And a lot of its kind of take rate stuff involves it investing in behind price and keeping prices lower. And the thing that you need, though, if you're going to be a successful EDLP business, and I get that there is a constant attraction, right, to being the cheapest and fastest and best doing these things, whatever that is, whether it's transferring money or anything else. That will always work for customers, and that will give you an element of resilience here. But what you need in order to make any money like that is scale. And you therefore need to have lower costs. You need to have lower costs than everybody else, and the most obvious way to do that is by achieving massive, great scale. And Wise is gradually working towards that, right? And as it scales, what it keeps doing is using its scale to push down its cost, which is effectively widening its moat around its business. And the bigger this gets, the harder this becomes to displace. And that's why all these things like customer numbers matter and volumes going through. So, I mean, you can keep your profit. The profit growth is strong through all of this. I mean, underlying, and I actually think the more I look at this, the more I think 1% is a conservative underlying interest number. I think they will get more than 1% for quite a while. That's a minor kind of quibble in the grand scheme of things here, but if you look at their kind of underlying income growth, so it's up 13 or 15% or 16 or 18 for the year, 13, 15 for the quarter, 16, 18 for the year, it's growing perfectly well in this situation. And I think that's the thing people ought to pay attention to here, even if they are both growing and strengthening, which is sort of impressive here. I was talking to a guy called Andrew Hollingsworth on X now, Twitter, who writes a lot about these kind of EDLP things, and he runs a fund, and his big thing is about, I mean, this is everyone's big thing, right, of buying great companies when they're under pressure or look like bad companies. But he really means it most of the time. And people always kind of nod and say, yes, that's what you should do. You should buy good businesses when they're priced like bad businesses and so on. And he kind of notes, though, that while a lot of people say this, not a lot of people kind of actually do it, because buying them when they look like bad businesses will be at a time when it looks like something is badly wrong. And he's positive on Wise and he owns Wise. And I said, how does this fit with that idea? Because I've never seen Wise, I think, priced like a bad business. I've seen Wise priced like a good business or like a really good business. And his reply was basically, yeah, you're kind of right. I've decided that sometimes you basically just have to pay up for great businesses and scratch the priced like bad businesses part of the equation. And okay, I respect that as kind of honesty here. But the point with Wise is it never looks fabulously cheap, but it is growing and it is strengthening. And if you want a business that's going to do both of those things and it's competing incredibly well here, it's difficult to look much beyond this, I think. I mean, it's difficult to look at it because it's not in an index and therefore it doesn't show up on many screeners. But I'm very impressed by this.
Yeah, I think the first thing the FTSE could do to maybe give it a little bit more respect is just change the stupid rules about ownership that absolutely nobody cares about, and just let it get into the FTSE. It would probably go straight into the 100, wouldn't it? So probably been somewhere near the top. Just having a quick look through the market caps now, it'd be in between Segra and Admiral in terms of market cap if this is up to date. So just a bit smaller than IAG, Sage Group, Scottish Mortgage Trust, and Halma. And there was a company in there, Steve, that it would have been a bit bigger, Bunzl. But we'll try and get onto that in a little while.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.